What if I told you that one humble Hong Kong snack chain quietly turned a few candy shops into a multi-billion-dollar retail empire, even while pandemics and rising interest rates battered the city's economy? This isn't about convenience stores or bubble tea fads. It's about Best Mart 360 Degrees, the homegrown retailer that built a fortune selling happiness in small packets. From the chaos of 2019 to the slow revival of 2024, this company kept expanding. Higher profits, stronger margins, and surprise new alliance with state-owned China Merchants Group. So, is Best Mart 360 now Hong Kong's next hidden consumer champion, or is the sugar rush about to fade? Let's break down 6 years of financial strategy and risk, and find out if this retail comeback story is sweet enough to buy. Let's rewind the tape. Best Mart 360 was founded in Hong Kong in 2013. Opening their first store in Sheng Siong. What they do is simple. They run chain retail stores selling imported, pre-packaged snacks and other grocery products. Think chocolates, dried fruits, nuts, beverages, everyday household items, and personal care goods. Their mission: deliver best quality and best price via global sourcing and make shopping a pleasurable experience in an easy-to-reach retail format. Since listing on Hong Kong Stock Exchange in early 2019, the company has grown its footprint, primarily in Hong Kong and Macau, expanding its store network and leaning into the leisure snack niche rather than traditional supermarkets. A key milestone. In the year ended December 31st, 2024, it reported revenue of about 2.805 billion Hong Kong dollars and profit attributable to shareholders of around 247.5 million Hong Kong dollars. And it didn't stop there. The board recommended a final dividend of 10 cents per share, 10% yield for 2024, signaling confidence in its recovery and cash generation. So what used to be a local snack retailer is now a listed player with strong margins, disciplined growth, and a clearly defined niche in the retail landscape. Now that we've seen the pie chart, with about 97.7% of revenue coming from Hong Kong, only 2.3% from Macau, and virtually nothing from mainland China, it paints a clear picture where Best Mart 360 Holdings Limited stands today. But therein lies the opportunity. While Hong Kong continues to anchor the business, the tiny slice from Macau and the near-zero presence in the mainland market suggests room to grow. The report reveals that as at December 31st, 2023, the group operated 7 stores in Macau and 1 in mainland China. Management sees this as a launching pad. With Macau already contributing a modest portion, the next frontier is mainland China, a vastly larger consumer market where the leisure snack format could scale. Earlier commentary noted the intention to utilize the broad visitor flows from the mainland into Hong Kong and potentially tap into the Greater Bay Area's retail connectivity. So as we interpret the chart, think of those small slices not as marginal burdens, but as early signals of future expansion. If the company can increase its presence in Macau beyond 2% and make meaningful inroads into mainland China, even a lift of 5 to 10% of total revenue from these markets would diversify the risk and add a growth dimension to their Hong Kong-dominated base. In short, the pie chart isn't just a snapshot where they are. It's a roadmap of where they could go. Now, let's break down the numbers. This table tells the story of how Best Mart 360 transformed from a pandemic-era struggler into a consistently profitable retailer. Back in 2020 and 2021, revenue dropped below 2 billion Hong Kong dollars, and the company even recorded losses. Net margins dipped into the red at more than -1%. But starting in 2022, we see a strong recovery trend. By FY 2024-25 TTM, revenue hit 2.8 billion Hong Kong dollars, with net income climbing to 248 million Hong Kong dollars, marking the 3rd consecutive year of growth. Operating margin doubled from around 5% in 2021 to over 11% today. Cash flow also improved significantly. Free cash flow reached nearly 295 million Hong Kong dollars, even after 1.8 billion in capital expenditure. The balance sheet remains solid, with a debt-to-equity ratio below 1 times and over 8 billion Hong Kong dollars in cash reserves. For shareholders, it's been rewarding. Earnings per share rose from just 11 cents in 2021 to almost 25 cents, while the dividend per share jumped to 21 cents, giving a yield of about 10% at recent prices. Returns have also rebounded. ROE at 17% and ROA above 6% show stronger capital efficiency compared to the post-COVID years. In short, these figures show a company that has recovered its footing, tightened its operations, and built financial resilience, turning what was once a local snack retailer into a stable, cash-rich, dividend-paying brand. If you've crunched numbers all the way to this part, congratulations, you now know more about snacks and spreadsheets than most analysts. Please hit subscribe, drop a comment, and tell me, would you buy into the snack stock or just buy the snacks? Now, let's take a look at how the market values Best Mart 360 over time. Back in 2020, after listing and getting hit by protests and the pandemic, the company's market cap hovered around 1.2 billion Hong Kong dollars, with losses, so PE wasn't even meaningful. But as profits returned, PE fell from about 45 times in 2021 to just 10 times today, showing how earnings have caught up with the share price. The enterprise value also grew steadily, from 1.4 billion Hong Kong dollars to 2.18 billion Hong Kong dollars TTM, supported by consistent cash flow. Meanwhile, EV/EBITDA dropped from 9 times to around 4 times, a huge improvement in operational efficiency. Price to book hovering around 0.17 times to nearly 0.2 times, signaling the stock is significantly undervalued. And also check out those ROIC and ROI numbers, 36% and 47% respectively, showing the business is squeezing strong returns from its capital. In short, what started as a small-cap snack stock has quietly matured into a stable, cash-generating, efficiently run retailer that still trades at a relatively low multiple compared to its growth story. Now, let's take a look at how Best Mart 360 stacks up against other major retailers in Hong Kong. Starting from the left, Best Mart 360 may be small, with just 2.8 billion Hong Kong dollars in revenue, but it's the only one here consistently profitable, earning around 248 million Hong Kong dollars last year, with a healthy 8.8% net margin. Next, CEC International, the parent company of 759 store, brought in about 1.4 billion Hong Kong dollars in revenue, but slipped into a loss of 44 million, showing how tough Hong Kong snack retail competition has become. AEON stores, a familiar name in shopping malls, reported 8.1 billion Hong Kong dollars in sales, but a loss of 338 million, meaning even the big players are feeling the consumer slowdown. On a much larger scale, DFI Retail Group, the regional giant behind Welcome, Cold Storage, and 7-Eleven, posted a massive 69 billion Hong Kong dollars in revenue. But after restructuring costs, it still reported a loss of nearly 1.9 billion Hong Kong dollars, although its underlying profit actually turned positive. And finally, the heavyweight, PARKnSHOP, part of CK Hutchison's retail division, contributed to a whopping 190 billion Hong Kong dollars in sales. However, CK Hutchison doesn't break out supermarket profits separately, so we can't see its true margin. So, if you compare them side by side, Best Mart 360 punches way above its weight. It's the smallest in size, but one of the few still turning a profit, showing that being lean and focused sometimes beats being huge. Before we get too comfortable with the numbers, let's zoom in on the risks for Best Mart 360. First up, executive governance. In August 2024, the CEO Hui Chi-Kwan was arrested by the Independent Commission Against Corruption (ICAC) on suspicion of bribery. The company insists the business is unaffected, but the trading suspension and investor jitters say otherwise. Then there is the social protest risk. During the 2019-20 Hong Kong unrest, dozens of its stores were vandalized. One report says 59 stores have been damaged. Another claims up to 75 of 102. On top of that, the company is operating in a very mature, highly competitive home market. Hong Kong's retail sector is under pressure from fewer tourists, falling mall footfall and rising mainland online/offline rivals. One recent article argues that even after appointing a new chairman, the market gave a muted welcome because these challenges remain. So while Best Mart 360 has upside via its niche snack format and book value support, these governance, protests, and market environment risks are very real, and they could easily dampen momentum if one plays out. Looking on the bright side, Despite scandal, protests, and fierce competition, Best Mart 360 is still standing strong. It's profitable, cash-rich, and backed by a powerful parent in China Merchants Group, a combo that many Hong Kong retailers can only envy. But the real question is, can this snack giant stay sweet amid a changing Hong Kong landscape? If you've enjoyed diving into the numbers with me, smash that subscribe button, drop a comment below, and tell me, is Best Mart 360 a tasty buy or a value trap waiting to expire?